Hey everyone, I'm Kriti. I'm the founder of Mantis, and welcome to the third episode of our podcast. We are an ARR reporting and forecasting tool, and we interact with a lot of finance leaders to understand what is going on. We have Shobhan today, who's the VP of Finance at Roundtable. Thank you, Shobhan, for being with us.
Most welcome. It's a pleasure to be here.
Perfect. So, Shobhan, maybe we can start with your introduction. Would love to know what you've done in the past, what you're doing right now, what is Roundtable. So, yeah, we can start with that.
Absolutely. So I think my journey into finance started long ago. I started back in India. We started a quasi entrepreneurial group in a company, on a bank called Standard Chartered Bank. It's quite well known in the Middle East, Asia region. And I did, business. I started a business, product management business, a new business from there. Did sales analytics and was in investment banking and FP&A for some time, and that's the main course or the foundation of my career. After doing investment banking and from 2008, so just after the financial crisis is when 2010 actually, when I joined formally investment banking, after the massive issues that the world faced in 2008 to 10. I was there for about 5 years, and then I joined PayPal, which was my first foray into fintech. And this was just before the split of eBay and PayPal. In fact, I was a eBay employee for a week. I have a badge that was valid for a week. This was my shortest stint ever. And I was there for about 6 years. PayPal was like the basis of fintech for me. Then I was in Dropbox for a short stint, learned about SaaS uh, and all the elements of SaaS. So learned fintech from PayPal, SaaS from Dropbox, and in Routable, it's a Series B B2B accounts payable automation company, and we do we connect with all of your ledgers, talk about QuickBooks, NetSuite, and Sage, and so on, and we can automate the whole accounts payable. I think the biggest thing about Routable, or the biggest strength for Routable, is we can do anywhere from 2 transactions a month to 200,000 transactions a month. So our scalability is very high, and we can send money, remit money across the world for B2B transactions. So it's a very good, very strong, robust system to do mass vendor payments. It's been a very good startup experience, interesting startup experience, just like you're also a startup, so you know how interesting that can be.
Yeah, no, absolutely. And I think you touched upon two things which I would love to talk about. So you mentioned about the 2008 crisis, which also takes us to the macroeconomic conditions today and how they are changing. And would love to understand, how do you feel they have impacted the startup ecosystem right now? What are some of the things that you are noticing on a day-to-day basis as compared to like 2021, the COVID years? How have the buyer preferences changed over time?
Yeah, I think the biggest change first of all, I think things are changing much faster than what they did in 2008 to 10,
Mhm.
right? I think information was not as freely available in 28 to 2010.
Yeah.
Now you can literally get everything in this drop of. You can actually ask the biggest supercomputer in the world and say, ask questions, and the AI will answer all of your questions. So things like that didn't exist. So I think the biggest thing that's happened is capital has become more expensive.
Yeah.
And because of that, there is a tougher business environment. And that tougher business environment is coming through in the focus that our clients, both current and prospective clients, are seeing in terms of how they're thinking about buying new products. So products, specifically buyers, are more structured in the procurement process. They know exactly what they want help in.
Yeah.
They know exactly what they want to spend money on and how much they want to spend money on.
Yeah.
And they want really clear ROI for those spends.
Yeah.
So this is something that's from every perspective, I'm seeing that come through on a daily basis. So they're looking at efficiency, they're looking at cost control, and they're looking at how can I show that efficiency quickly or recognize that efficiency quickly. And both Routable and things and FP&A products, which focus on getting that financial strength back, are very positives from that angle.
Yeah.
That I
Yeah.
It's not growth at any cost anymore. It's like sustainable growth.
Yeah, absolutely. And because you talked about sustainable growth, usually like in an organization, the finance leaders are talking about sustainable growth, while there are GTM teams who are talking about growth, right? So, how you as a VP of finance, as a finance leader in the organization, trying to get everyone together and get everyone on the same page while we are facing these conditions.
Yeah, I think as a company, and this is not only in Routable, but also, this is a time when finance actually gets a lot more important say at the table. Like when things are going good, nobody cares about finance, right? But when things are tough, that's when finance actually has something to say.
Yeah.
So we, in all the companies that I've spoken to, advise, and current company to, I feel finance has three different things that we are focusing on to make sure that everybody comes together.
Yeah.
The first one is, I would say, efficient deployment of capital. I think that's, everybody has to understand that we don't have unlimited capital.
Hmm.
Our capital has to be focused on very key areas. Go to
Hmm.
market is one of them, which is why sales will talk about go to market. But now it's like, okay, I want 15 A's to spearhead this. You get 5 and you show that benefit, and then you get the next 5, you show that benefit rather than getting 15 on the first go. So things like that. So you need to deploy capital very well. So that has been very positive, because every part of the business has understood that capital is not free.
Hmm.
It's important to be deployed efficiently. The second one is and we've been a little lucky there, but we have been looking at financial strategy and execution of that financial strategy. So I always think that it's important for at least the exec team and the departments and the key stakeholders in those departments to be very clear about how we want to spend the next year or 2 years in. And I look at it from 12 months from this year, but I also look at 18 to 24 months, is how I typically think about the financial strategy. And it's the main thing about that is execution,
Yeah.
right? And that's where data becomes very important. And
Yeah.
that's where efficiency becomes very important, right? Because you want to make sure that your CAC is in line, your unit economics are there, like you are spending marketing, your marketing efficiency is being calculated properly, and not like a fluke, or not like a random efficiency calculation. So those two things have been helpful in making sure. So we always come back. If there's a question about can we spend here, we always come back to these two elements. Are we deploying capital the right way? Is it following the right capital financial strategy? Now, in financial strategy, in true FP&A world, there's a base case, worst case, best case, right? So you want to make sure that you are aligning yourself to whichever case you are at that point of time. And the third thing is, and I help managing that in Routable too, the risk and ops management. Like you got to have a very strong risk and operations one. And finance is like the pillar of operations in some form.
Yeah.
So our product, for example, is an accounts payable product. Right? So you have to be very clear that which vendors you're getting, when are you getting them, how are you getting them, how are you paying them. Again, it goes back to efficient deployment of capital, financial strategy, but you can't do those two if you don't have a very strong operations and risk management.
Yeah. Yeah, and because you mentioned execution, right? So, like, to be able to shift that mindset from which was earlier, which was growth at all costs, to moving here, what are some of the challenges that you have faced as a finance leader within the organization over the last few months, just to make sure again that everyone understands that capital is scarce right now and they won't just get 15 A's when they come and want.
Yeah, I think having clear metrics has been extremely used. Let's just take an example, right? Let's take an example of sales comp,
Yeah.
right? You have to align your sales comp to your goals of a company, whether it's the number of logos,
Yeah.
whether it's how many leads you're getting, whether it's revenue, whether it's CAC, unit, whichever that one is. You have to align your sales comp, or that sales comp should reflect the metrics that you're trying to solve. So having a clear definition of metrics, and again, go back to financial strategy, because that's where you define, okay, I want the next 2 years, I want to get 150 logos a month. Great, right? So you have to define, having that metrics definition has been very helpful in making sure everything is aligned. The second thing, again, going back to metrics, and that's why I come back to how you are managing your risk, how you're managing your operations, and having good, clear data which people can look at and see how they're performing.
Yeah.
So if you look at ARR, which your tool efficiently does, right? ARR, it can be, and specifically in a usage-based kind of a world, ARR is a very different kind of an element than a pure SaaS kind of thing. And making sure that people understand how ARR is being, and refining that for your company and making sure people understand that has been helpful in, okay, am I impacting ARR or am I not impacting ARR? Is my focus on ARR or is my focus on revenue?
Yeah.
Or a blend of those two. So long answer to your question, or short answer to your question, is having clear metrics defined has been very effective.
Got it. Actually, on that point, we do keep getting a lot of questions every time we talk to prospects. Otherwise, like, what is the right way of defining these metrics, right? And again, there's no right answer there because it is very contextual. But how have you gone about it very tactically? Like, how do you define your ARR? What is your sales compensation based on? Just, yeah.
Yeah, and we have gone through kind of a fact-finding mission on this one too. Just like you speak to a lot of people and you're getting podcasts and stuff like that, we actually went through and spoke to people to understand how the hell do we define ARR for a company that's a mix of SaaS and usage-based.
Yeah.
So the way we have defined ARR is more on what is the predictability of that revenue coming in for the next 1 year. If I have more than 90% predictability of that revenue coming in, I would put that as ARR. Now, in a very simple example, if you have like a platform cost that you pay for, that's simple. Like I know I have to pay, $10,000 as platform cost. Fine, that's ARR. Then on a usage one, do you have a minimum that we're talking about? If we have a minimum talking about, I can put that in ARR. Either it's in terms of minimum amount of usage or minimum amount of revenue, including the platform cost or not. So that comes all into that ARR world. But I can define ARR there. Now, since you've asked that question, prediction of ARR is the next step, which I think you guys excel in that part too. But for I've come to realize that SMB versus enterprise prediction of ARR is so different from each other, right? And enterprise, I like to go client by. I know a company that has about less than 10 enterprise clients. They do more than $60 million in revenue. And all they do is just focus on these 8 to 10 clients. That's it.
Yeah.
But when I do prediction for them, and I literally went through this process with them, is I have to do it on a client by client basis.
Yeah.
In SMB, I do it on a portfolio basis. Mid-market is in the middle. So my way of prediction is that if a client is giving more than 5% of your total revenue, I would move that away from a predictability from the SMB side or portfolio level. If it's less than 5%, I would probably like to club them. Again, depends on number of clients.
Got it. Actually, that's very interesting because you mentioned that you only take just the predictable part plus minimum commit part of your revenue, like as ARR. Have you ever thought of taking like the usage-based piece at all, like the overages that you have? Yeah.
Yeah. So we have a lot of seasonal variation. So in our company, people pay quarterly payments. So at the end of the quarter, either in M3 or M1, late M3 or early M1, there's a big spike that comes through, right? And then there are annual payments, which we don't know when that's going to happen.
Yeah.
So the way we look at predictability of ARR is that if a company has been giving us a revenue of 80%, like I can say by 80%, this much revenue is going to come in every time. That one, I will put it in ARR. But there will be 1 month in which they'll go 120, 130. And that's where the problem is. Now that one, if I have enough history with that client, then I can predict then I can say, okay, this is that predicted 80% I can predict for every month. And then there'll be this X amount that then I can put it in ARR. But that's why you need more history with that company to put that ARR into place. I have had both favorable and not so favorable responses on putting one-offs into ARR. And I've had to explain this massive swings of ARR. ARR should be relatively very predictable, right?
Yeah.
And that's my whole idea of how to do ARR. And then, if there's a churn, if there is, or a potential of a churn, that's when you have to adjust the ARR. Technically, if you really do it from the pure holistic side of view, if there's a churn or there's a potential of a churn happening, then you should show it as a RNO in ARR, risk and opportunities in ARR. That we expect this client to have some churn potential, so I'm going to put that as a risk. You may not want to put it immediately in ARR, but having that reflection is very important, specifically when you're making data decisions. Because it's not just I have an ARR of 100 million. It's not as simple as that, right? When you're making decisions, you have to think about a shake of 100 million. I might go up by 2 million because of these opportunities, and there's this 0.5 million which might go away because of a churn.
Got it. Yeah, and that's interesting. In that case, how do you think about sales compensation? Is it then just based on the predictable part of ARR? Is it like, do you wait for the overages to stem and to see what the extra small percentages will be staying in the 80%? How do you go
Yeah.
about?
Again, we have gone through a sizable evolution in sales comp. I think everyone that I've spoken to has gone through an evolution in sales comp over the last 2-3 years. The way I think we have found out through various communication and realized where sales comp works is linking it to what we want. So if we want higher ARR, if I want higher logos, I pay sales comp based on logos, irrespective of what the ARR is, right?
Yeah.
And there are a few places, even sales comp is not one size fits all, right? There are a few ways which are focused on one thing. There are a few ways which are focused on renewals and churn and all. A few ways which are on just pure logos. So if they focus on pure logos, people would pay on that logo base kind of a sales. Specifically on ARR or revenue base, then the way you can split it. The first one is on ARR, you pay on the regular basis, and you define that ARR accordingly.
Yeah.
And then based on what is the overages that happen, you pay a percentage as and when their overages happen over the life of the contract. I think that has worked very well for at least 3-4 companies that I have looked into and have used that. The only difference is in terms of enterprises, because the size of the deals is pretty high. So typically we would pay in terms of, and the lead time is very high, the implementation could take more time. So that's where we pay more in terms of milestones that they reach. When they hit X percentage of revenue, Y percentage of revenue, and so on and so forth. So just like it takes probably 6 to 9 months, even a year sometimes to get an enterprise client.
Yeah. Yeah.
The sales comp will also there'll be a big sales comp on the agreement signing part. That's milestone, and then the milestones will be defined accordingly.
Got it. Got it. Yeah, makes sense. And I think we have again seen different people doing it differently. Some people just average it out for a few months initially and then pay it. And some people do it the way that you mentioned. The other interesting area is also on the metric side itself. When we talk about ARR is renewal, right? Like when do you recognize the renewed ARR? Do you wait for a few months for it to come in, or do you recognize churn earlier? Again, different answers there. Would love to hear how you go about it.
Yeah, we specify it we look at it from a risk and opportunities perspective more than anything else. I think depends. So the first one is if you're looking at from a portfolio basis, so we have a pretty big SMB focus, and we have mid markets and bigger clients that are coming in.
Yeah.
The SMB predictability, we can know how much churn is happening, right? And we have a pretty decent idea now on churn there. So that is more of as it comes through, it's in the forecast. So as it comes through, we recognize it, whether we are hitting that number or not. And that's people understand it. It's very clear. It's the bigger ones that we show in risk and opportunities. I typically like to recognize churn as incurred, even though I would like to show it as risk and opportunities there. So if it's incurred, so when we know that this churn is definitely happening, that's when I like to incur it, because there is always a path to it. I will show it as a risk.
Hmm.
If we are trying to save the client either through different elements, pricing, give more support, what was the missing value, maybe even doing a free trial for revised ones they are coming through. That's the same thing. Same thing I do in the renewal side. And renewal side, if it's we have auto renewal process, so that's easy to think about. But if there is an upsell that's happening,
Hmm.
um, it depends again on whether it's an overage upsell or it's a minimum commit upsell or a SaaS upsell. So if I have a platform and now I can do vendor checks with us, and vendor checks are committing to a particular amount, then I would recognize that as yeah, because we have committed to that amount.
Got
And
it.
if it is based on that. Now, a lot of those things happen once a year or twice a year kind of a thing. And in that case, I have to wait for that to come through, because I don't know if they're going to do 40,000 vendors or 100,000 vendors, right? So it's very difficult for me to recognize ARR there.
Got it. Got it. Makes sense. And how has this been different as compared to some of your earlier companies, which are slightly bigger, right? Like Dropbox, PayPal, which are like a lot more people there, a lot more complexities.
Yeah,
Understand.
yeah. PayPal is a fintech company, so it's primarily usage based, even though there are elements of SaaS there, but it's a primarily usage based company. So
Hmm.
that is more in you recognize revenue, you spend on PayPal, you pay someone, you PayPal gets the revenue from it. So it's a very straightforward one. ARR is mainly a SaaS terminology, even though it has come into every part of business. Everybody's asking for ARR, but it's basically a SaaS terminology.
Hmm.
Dropbox is all about ARR, right? It's a fixed price per month one. And that's where, all of my basis of my thought process on ARR comes from how we thought about ARR in Dropbox, the various options we had, and trying to see how Dropbox is purely a SaaS-led thing. There's upsell that happens, and that becomes a new era. And there's limited usage-based kind of a costing there.
Yeah.
But when we started looking at different business cases, we saw that problem coming through. So a lot of my thought process on what are the different options, and I mean, Dropbox is a $2.5 billion revenue company, so it's a massive company. So the good thing about that was you had the mentorship from people who have either done this before, have seen this before. You can talk to people and get a lot more info.
Yeah.
And using that is how I try to define the way we think about ARR and Routable, because it's a mix of both in some form, PayPal and Dropbox. It's a SaaS company like Dropbox, a fintech company like PayPal, and the mix of those two. So I mean, Steve Jobs said that you can always look back and connect the dots. I'm connecting the dots on Audible with both Audible and Dropbox, and for all practical purposes, the investment banking area, because you look at capital so closely here.
Yeah. Yeah. And if we can also dig a little deeper into the challenges that you face there versus the challenges that you are facing here, both from like uh, your just metrics perspective, reporting perspective, just even knowing what the right numbers are to look at, or even if these numbers are right or accurate in the first place, right? So, what are some of the main challenges there versus here?
I'll take you through a little bit of a story there. So when we split from when I joined the eBay PayPal, eBay was a public company, it's a
Yeah.
well-established company. And we split from that. A lot of those well-established um, processes were just transferred, and PayPal could take advantage of them. The data cleanup that you have to do was was relatively was easier. It's only when you buy new companies coming through, and that's where the biggest challenge used to happen,
Yeah.
is because their data or their tech stack was very different, and to aligning that, making sure it somehow translates. And this was not, SaaS tools have become very, like, they connect with a lot more tools now.
Yeah.
At that point of time, there's still the number of tools that would connect to two different elements was very different.
Yeah.
So that I think the cost and integration from a data perspective was much more difficult when things were bought, like M&A, and PayPal was a very strong M&A shop. They would do a lot. With Dropbox, there were two elements to it. Dropbox has its own like they do most of the thing in-house, and they're a very strong data focused company. And in fact, data is like the core of Dropbox coming through. So they had their own way. The problem with that was you could use tools because they had their own proprietary system to do everything. So you couldn't use an external tool to help in that one. In Routable, I think we were fortunate because our founders have done or worked with startups before. So they knew this was going to happen. So we use more tools that could connect with a lot of other ones to make sure that the data is clean or
Yeah.
cleaner.
Yeah.
The problem happens is when you start adding new products.
Mm.
So now when we add new products or we enhance our product suite in whichever form, right? International payments, right? We always try to see, even while creating the product, and how the data is going to flow into the data warehouse and how that information is going to come out from there.
Yeah.
And I think we're still learning on that front, but it's in a much better state than what I would have ever expected us to be in 10 years ago. Because you can get all of that information now, because that's one of the key elements when you're doing products.
Mm.
And it's not only for us, like companies, we are an API first. So
Yeah.
companies can literally download everything and get integrate with their own softwares in some form.
Yeah.
And I know you guys also do the same. Like the whole idea is you guys can integrate with 15 different tools now compared to 10 years ago. You had to be either one tool or the second tool. And if an M&A, one of the elements on the M&A discussion or the checklist was, can they integrate with XYZ?
Yeah. Yeah.
Now that's no longer even applicable because it's expected that they have some way of integration anyway, or we'll figure that out because some of our vendors or even internal, we can integrate with them.
Yeah.
So it's that is the first. The bigger problem has been always forecasting and changing forecast and making sure that the actual versus forecast is managed and updated in a one, because we we keep on going to bigger clients, and the way we service small clients versus bigger clients very different.
Yeah.
And that is where we have kept on. That's the evolution of the data warehouse or tech stack. Scalability has been a very key part in our whole tech stack process. So, and that's been a critical element for our data warehouse too.
Got it. No, makes sense. And I think I completely agree. Like for us also, we like initially the question was, can you integrate with X or Y, or do you already have integrations? But even if we don't have, we can just like get them up and running very quickly because of everything that's available right now. So it's pretty easy to get those in place. Because you touched upon forecasting, would love to probably get again deeper into that. How do you do your forecasting today? What are some of the challenges? And again, with the usage-based element being into place, what are some of the complexities that come with it?
Yeah, we use we've integrated with traditional forecasting tools, but more importantly, first thing, let's talk about forecasting. So actuals is one part of it, and so getting right actuals is and making sure that those actuals are correct. That has been a key element too, because it sets the base for everything anyway. I think from a forecasting process, it's been a mix of both automation and manual. So on the automation part, has been for our portfolios, which are more for smaller businesses. So if we use that as a portfolio element, and that has been more automation focused. We also have a longer history with them because we started as a more of a SMB or small businesses kind of a product. So we are able to predict more both seasonalities and peaks and troughs with the relative certainty, and that's been very helpful. Plus, again, SaaS helps, and SMB's usage base is in a particular range. So, I was in infrastructure banking a long time ago, and you had this base case or base load plans, and then you had these peakers. And base load plans are basically you can get X amount of usage month from this portfolio.
Yeah.
And then there's elements that when you can go up and down, or that element of increase and decrease, that's where it depends on seasonality, depends on vertical, depends on product. If it's an e-commerce vertical that or e-commerce merchant, they have a lot more Q4. If it's our back to school day, so these elements that come through, as against if you have a company that is more into logistics, it's pre Q4, right, when things are happening and so on. So that's the first part of it. Then as we go to bigger and bigger clients, that has become, some clients I have to look at forecasting on a client by client basis because they're just too big, and they contribute a lot more than what a portfolio would. And at that point of time, it's more in terms of having a relationship with them and understanding their needs. And their needs are also much more complex. And for in the middle of them are the mid-market, like massive mid-market range. And we've divided our mid-markets into smaller, sections. And some of them require a more deeper one, which can be like that is one portfolio having 3 clients only because together they are size sizable. And the first one can be 15, 20, 30, 40 clients in one cohort kind of a way. So we do more of a cohort analysis for that one.
Yeah.
It's a little, so it depends completely on what kind of customer profile. If you have a bigger, larger customer profile that you're working towards, you have to forecast them in that way. One size fits all can only work if you have a similar kind of a customer base.
Absolutely. I think I've heard two very similar things from other people where you have these 3 buckets, right? Like the top 5% customers, you're forecasting them individually. Then the other one is more cohort based on region, industry, etc. And then all the other ones which
All
sit.
the tail is all in one portfolio,
Yeah.
but as a basis, yeah. And I think all 3 companies that I've been part of, as well as any company that I've looked at, I've either tried to define that or I've learned from them. And this has been the most helpful work
Yeah.
to come to.
Yeah.
And so it puts a lot of pressure on the finance and FP&A folks, by the way. And that's why I guess you need tools like yourself to make sure that you can do that much easier.
Yeah, no, absolutely. And talking about tools, we'd love to also understand like what does your tech stack look like today? What are the things which have helped you and how have they evolved over time? What are some of the processes that you have put alongside them to ensure that things stay well from the beginning itself?
Yeah, I mean, so we are a fintech company. And the positive part about a fintech company, or negative, the way you want to look at it, but we have to be very clear about our risk, security, and so on. So the first thing is we have a threshold for any integrations. Not only customer data, like customer data has a much higher level of security, but even corporate data. It's quite high. So that's the first part. Is any tech stack you look at, it has to align with those XYZ. It has to take like 15 boxes, otherwise no conversation. I think the evolution has been, we are just like at the start of the call, we talked about B2B, right? We are also very sure about what we need. So every department wants something to help them become more efficient.
Yeah.
But I don't have unlimited capital. So I have to make sure it aligns with business strategy. I'm deploying it very well, which means only things that come through which have a which align with business strategy and have a tangible ROI coming through.
Yeah.
That's been our first element on whether we look at that introduction into that tech stack or not. A tech stack obviously has tools which are pretty well. I mean, we use our own platform, and we are a part of multiple hundreds of companies who are using us in their core AP platform. And so the second part of it is scalability and flexibility, because that's both PayPal, Dropbox, and now Routable. All 3 companies have one thing which is very clearly seen that I can see looking back and today, is the ability to scale. So if I have a HRIS system and it cannot scale beyond 500 people, that doesn't work. Right? If I have an AP platform, and you're doing 1,000 transactions, suddenly you do 5,000 transactions, and you have to change that doesn't work. That's why the core part, can it send domestic and international? That's why we had to focus on international, because the companies were coming in saying, dude, I can't have 2 different AP platforms, right? So having that scalability and flexibility, if I start a new product line from my FP&A process, right? If I cannot define that and have a clear indication of that coming in, it doesn't work. So that has been the second part of it. The third part of it has been, do want to integrate all of them into one place, in the sense somehow that tech stack has to get all the elements without naming like particular ones coming through. They all have, there has to be a way for me to get information from one place to the other. I don't want to have a person who's just going from to one system, getting the data, then second person getting the data, third, and then trying to integrate it in a Google Sheet or Excel, right? So that's what I want to avoid from many elements. So that's been there, which has come up by, and that has in some form or shape made sure that our tech stack remains lean and agile, right? Because not every company can do it. And so if the cost of implementation or the time of implementation, again, I don't have unlimited resources, right? And the world is a tougher place than it was 2 years ago. So that has helped define that tech stack and very well. I must say that having a efficient finance org helps a lot,
Yeah.
and having finance as one of the gatekeepers on which vendors or tech stack to come through has helped a lot. And the other thing, the last thing I would say on this particular element is we have reviewed our tech stack every year.
Mm.
We have, and finance and IT and risk has reviewed the tech stack every year. And if we don't see enough engagement on a tech platform, we cut it off.
Mm.
Very last week, I was talking to someone, and I got their tech stack cut by 60% because they had people using different tools, and they were paying for like X number of ones, only 10% of them were using it.
Mm.
And so it says you have to combine all of them together. But because they're not reviewed it for the last 2 years, because things were, it's been a very dynamic environment. About a year and a half, we put up a rule that every year we'll review our tech stack in the middle of the year, just before the renewal season starts, and see which ones are we going to renew or not.
Got it. Got it. And that makes a lot of sense. And some of these processes that you set up now, like, is there any process that you think about and you wish like I should have set it up 2 years back, 3 years back, or like way earlier itself, which maybe you started just now?
Yes, the answer is you always look back and you say, "Oh shit, I should have done that earlier."
Mm.
Um, I think it comes with the evolution of the business as well, right?
Mm.
In a startup specifically, even in bigger companies, both in it happens all the time that you have to evolve the business.
Yeah.
When you start evolving businesses, there are elements that you realize you should have done that you're doing now. So, for example, how to set up a good financial strategy
Yeah.
and change it as either the business environment changes, your customer profile changes, or your product changes.
Mm.
It's something that we have come to rely, we are much better on that one today than what we were 2 years ago, right? And the way we align our different roles within the exec team as well as broader departments has also become much more streamlined.
Mm.
We are a remote company, so our dependence on tools is very important, and having that making sure that dependence on tools is helping you in your financial or not constraining you in your kind of financial strategy is very important. I do think that in 2020, 2021, everyone was spending a lot more. Growth at all costs was the one. And I wish that we did stop it very early, or I think earlier than what the rest of the world did, but we could have stopped it a lot more and had more sustainable growth. But the good thing is we learned from that, and we realized that a product needs to be enhanced. We invested in the product. So there are learnings from there. I wish we had learned sooner. I mean, I wish I'd learned the guitar when I was young, and now now it's so much difficult to learn it. Or so things like that. You learn a few things through making mistakes or on hindsight. That was one thing. I think we have definitely made our FP&A process more robust. Our operations is much more robust. But that's also because our customer profile has become more mature, more sophisticated. So we've had to do that. And that has been very positive. That's pretty much it from. I think it's still a revolution, Kriti. I don't think we've still solved everything, and I'm the most efficient performing organization in the world. Uh, I think it is. We are moving into much more mature clients, and mature clients have higher needs and they
Yeah.
have higher expectations, and we have to align our own internal processes to help in that to keep on providing that value.
Yeah, no, absolutely. And I'm sure like there'll be a lot more learnings going forward as well as and when you involve. Perfect. Sorry, go ahead.
I think overall it's I think the next 2 years will be pretty interesting from a lot of processes, and from a finance standpoint the next 2 years will again we'll continue to focus on efficiency even more,
Yeah.
and in making sure that we can automate as much of processes as possible, whether it's data, FP&A, performance management, FinOps, where Routable comes through,
Yeah.
data where you guys come through from that angle. And that is one place where I've seen if people are not focusing or understanding what they're paying for 1,000 transactions is probably more, or they're paying for it. I've seen people pay like 5% for sending money internationally in a B2B. I was like, why? As FX rates are all over the place. And so if it's important for finance folks to understand, and that comes from the data side, right? So everything that I think people will be focusing on that piece for the next 2 years, a lot more than what they've done in the previous two.
Yeah.
And that will define, I think we're going to come out of it as a much more leaner, more efficient finance and broader organizations overall. It'll be interesting time in the next 2 years.
Absolutely. Perfect. And I think this is the right time for us to wrap it up. Thank you so much for the show. And this was super helpful. And this was a delight to have you here. Thank
Thank
you.
you, Gary.